For a lot of homeowners, equity is one of the biggest financial resources they have, and unlocking it could open the door to things like home renovations, education, debt consolidation, or covering major expenses. One of the most common ways to tap into that equity is with a home equity loan, and while that's a familiar term, the details of how it works and how it compares to other options aren't always as clear as they could be. So in this video, I'll walk you through what a home equity loan is, how it works behind the scenes, and who it tends to suit best. We'll also look at a newer option called a home equity investment, which might be a better fit depending on your financial goals. Before we get into the loan itself, let's take a quick look at what home equity actually means. At its simplest, it's the portion of your home that you truly own. That's your property value minus whatever you still owe on your mortgage. For example, if your home is valued at $500,000 and you owe $300,000, then your equity is $200,000. That number grows as you pay down your loan or as the home's value rises, and because equity is often your biggest asset, lenders will let you borrow against it. So let's talk about how that home equity loan, also called a second mortgage, actually works. You apply through a bank or lender, and they look at things like your home's value and income. They also check your credit score and debt to income ratio. If you qualify, you get a lump sum of cash and start making fixed monthly payments right away. Those will cover both the principal and the interest, and your rate is locked in, so there's no surprises month to month. That predictability is why a lot of people choose this kind of loan. It's nice to know exactly what your costs will be. Plus, the rates themselves can be lower. Because the loan is backed by your home, lenders typically offer better terms than you get with something unsecured like a credit card. And importantly, you still get to keep any future appreciation of your home's value, but it is not without risks. You're taking on long-term debt, and since your home is the collateral, missed payments could put you at risk of foreclosure. Also, lenders have fairly strict requirements, especially around credit and income, so while this type of loan is cost-effective, it's not always the easiest to qualify for. Now, a related option you might come across is actually a HELOC, a home equity line of credit. And even though it also lets you borrow against your home, it works more like a credit card. You're approved for a maximum limit, and you draw from it as needed. There are usually two phases, a draw period and a repayment period. During the draw phase, often 5 to 10 years, you might only pay interest on what you borrow. Then once the repayment phase kicks in, you start paying both principal and interest. The catch with HELOCs is that the interest rate is usually variable, so your monthly payments can change depending on market conditions. It makes it harder to predict your costs over time compared to a fixed rate loan. So the trade-off is flexibility versus stability. A HELOC gives you more range in how and when you borrow, while a home equity loan gives you structured predictability. But there's a newer option that works a lot differently. It's called a home equity investment, and one of the companies offering it is Point. Now, this isn't a loan. Instead, Point will give you a lump sum of cash up front in exchange for a share of your home's future appreciation. There's no interest, no monthly payments, and nothing is added to your debt. You only repay when you settle your home, refinance, or buy back the investment, and you can do that anytime within 30 years. There's also no penalty if you want to settle up early. Point also builds in protections that you don't normally see with standard financing. They only take a share of appreciation above a set starting value, so nothing can touch your home's original worth. There's also a cap on how much you'll owe back, even if your home appreciates more than expected. And if your home loses value, Point shares in that loss. Plus, because it's not a loan, there's no income requirement, and your credit score can be as low as 500. That can be useful if you're self-employed or recently retired. Now, if you're wondering how the process works, it starts with a quick pre-qualification. It takes about a minute and uses a soft credit pull, so it won't affect your score. After that, they order an independent appraisal to get the home's value and then make a final offer. The deal usually wraps up in about 3 weeks. At closing, there's a 3.9% processing fee with a $2,000 minimum, which is taken from the investment amount. There's also your standard closing costs for things like appraisal, title, escrow, and later on there might be some exit fees if a new appraisal or recording is required when you settle. There's also something called a repoint option, which lets you take out a new investment with Point to access more funds, and if needed, their agreement can roll over to your heirs instead of being settled right away. That gives your family some breathing room in how they want to handle it. So how do you decide which of these options is the best fit? Well, a home equity loan works well if you have stable income and want a fixed monthly payment. It gives you a lump sum up front, and the predictability can make it easier to plan around. A HELOC makes more sense if you want flexibility. You're not borrowing the full amount at once, and you only pay interest on what you use. It's ideal for phased expenses like renovations or education costs, but keep in mind that your payments can change over time. And then there's Point, which runs on a totally different setup because there's no loan, no monthly payment, and no interest. You get a lump sum up front, and you repay later with a share of the appreciation. It can be really useful if you're trying to avoid taking on more debt, or if qualifying for a normal loan is tough with your credit or income. And hey, if Point sounds like it might be the best fit for your situation, I left a link down in the description. We usually can get special offers through our affiliate links that you won't find on their main website, so feel free to check that one out if you're interested. So hopefully this gave you a clear picture of how these options work. If you found it helpful, I'd always appreciate a thumbs up, and if you have any questions, feel free to drop those in the comments below. I try to answer as many of them as I can. Thanks so much for watching, and I'll see you in the next one.